Next is a new and interesting stock. OXO fish stock. No. It's a stock called QXO, not OXO. I'll try and make sure I type this correctly when I write up the notes for this thing. But QXO is one that's come onto my radar pretty recently. And I kind of lazily wrote in an article for Fool recently that this thing has 500% upside. I didn't say that because I'm not allowed to say upside, but could go up 500% by 2035. And well, here's the kind of maths behind that idea. It currently has a market cap of about 12 billion, which makes it one of the biggest stocks in the FTSE 100 dollars. This is. It would be one of the biggest stocks in the UK if it was in the UK, and it's not. But $12 billion market cap. By 2035, they're targeting 50 billion in sales. And if you think they can achieve a price to sales ratio of 1.5, that's actually going to take this stock up quite a lot from this point. That'll take you from 12 to 75, which is, that's a big return from this. So the obvious question is, what does it do in that case? Because a 1.5 price to sales multiple is not a lot if you're an AI company. It is a lot if you're a retailer. It's neither of those things. It's also not a defense contractor, and it's not a GLP-1 manufacturer, which are the other things that have been doing pretty well this year. It's a distributor of building materials, which, it's one of the things that gets Steve excited, I think. But let's see how we go with this one. It's obviously in growth mode if you're talking about doing that with your market cap potentially in the next 10 years or so, and they're currently at about 2 billion in sales, as I understand it. But the market, as they point out, is worth about 830 billion, and every growth stock you've ever heard of that's got big plans has said the market is worth this. If we can just get this, our stock is going to go like this. And that's pretty much a story you heard all through 2020 with someone say, yeah, but look at the size of the market, man. It turns out that, getting hold of a market like that is harder than it looks in a lot of cases, because lots of people have this idea, and the people who currently control that market or are the incumbents in that market, they don't like giving their market share away like that. So what's going on here? Well, here's one thing to note about the business building materials distribution market. It is massively fragmented. And when you hear massively fragmented, you should think, well, there's only one way to get from 2 billion to 50 billion, and that's that we're going to buy everybody else's revenue. And it is usually the fastest way to grow in a market that's not doing super massive numbers, because this isn't, as I said, AI. So QXO is a roll-up. And we've seen lots of roll-ups on this show that we actually quite like. Compass Group has been a big roll-up. I like Bunzl, that rolls things up. Diploma's sort of a roll-up a little bit. Halma's another kind of a roll-up. Cohorts are a roll-up. There's loads of companies that we think grow pretty well through acquisitions, despite the fact that growth through acquisitions gets a bad name, and rightly so if you screw it up. But they've started by buying a company called Beacon, which is roofing and waterproofing, stuff like that. And they're going to add in more bits around this going forward. So they've got their kind of feet in the door here, and they're going to go and start doing some more buying. But anyway, you've heard this story before then. We're going to go and roll up an industry of a sort. What makes this one any different? Anyone who has the same idea. The answer is a guy called Brad Jacobs, who is their CEO. He is a serial roller-upper of industrial things, and he's done a pretty good job of it in the past. So between 1989 and 1997, which is between the time I was 1 and the time I was 9, he was busy running a company called United Waste, which is what it sounds like, a waste company. And he went about rolling up a fragmented waste industry, going from nothing to 2.5 billion, and then sold the thing to Waste Management. And nothing to 2.5 billion was a lot of money back then. He did that via a series of 150 acquisitions. The guy's done some acquisitions before. But after that, he, I think, built a company called United Rentals, and in 10 years and 200 acquisitions took that thing to 6 billion in market cap, and that's still public at the moment. Between 2011 and 2021, he then had a company called XPO, which is a logistics company that went from 150 million to over 17 billion in revenues via another 100 and many acquisitions and so on. And now he's got his sights set on building materials or building supplies distribution. And he's looking at these things tend to work on 10-year cycles with Brad Jacobs, and there's no arguing here that he hasn't been very, very successful in this kind of thing before. But this is the biggest project to date by some margin, trying to turn something into a 50 billion revenue company here. That's on a different scale to getting from 0 to 2.5 billion. The market might be there for it. I suspect he's identified an interesting industry to try and roll stuff up in, and he clearly knows what he's doing with an acquisition. So I wouldn't necessarily bet against him. But can he get to 50? I don't know. Does he need to get to 50 for this to work as an investment over the next 10 years? I don't think so. I mean, if he comes in short and he comes in at 45, it's still going to do well as a stock to own for the next decade or so. Steve, you're a resident building materials enthusiast. Does this sound interesting to you?
It does, yes. I did recognise the name when you said it, and he's got a fairly popular book out called How to Make a Few $1 billion. Yeah, I do know of Brad Jacobs. I have not read his book, but it is on my list of things to read. His acquisition of Beacon was quite well celebrated because I think it was his 500th acquisition he's made as a CEO of a firm. I think that's genuinely the case, Steve. It might be worth looking that up in the meantime. So, product-wise, very interesting. They have the Owings Corning range of shingles now under QXO. So shingles are, for those that don't know, they're like weird little square tiles, things that the Americans absolutely love. Unlike our tiles in the UK, which last like a long time, so 20, 30 years out of a tile, a shingle can go in about 5 years. So they basically put some non-waterproof ply. It's waterproof, but it won't be after you've banged some nails into it on the roof, and then you bang your shingles into it one by one with a hammer. These things are not durable, even though they're called things like true durable and duration. They do not last a long period of time, and you need to replace them often. So it's a big money spinning kind of thing for QXO. The other products they have are generally things like waterproofing, so flashing, things like that. But they also do, if you imagine your typical American home in your head, they have those kind of siding boards that kind of lap over each other and sort of ever so slightly point outwards. And they, probably in your head, that's painted a very pale green colour. They also do those, so residential siding. That's particularly interesting. They've got some metal roofing. They have a little bit of slating and insulation as well. Although if you watched how the Americans do insulation, it would drive you insane. They don't tend to use the rigid insulation that we use. They kind of just like chew it all up in a wood chipper and spit it all over the loft. So you open your loft hatch and it's like opening those old packing peanut boxes from back in the day. You get covered in stuff, or opening a glitter bomb. Yes, that's how they tend to do that. So look, these guys have a very good range of products that people will use. So that's what I would say is a pretty good start from me. I actually think this is pretty interesting from an investment sort of perspective. The only thing I've kind of got is that the net sales, despite going up so much, were actually a miss by about 1.5% over what was expected, which is kind of strange when you're talking about the kind of growth that they were talking about. It was nice to see some EBITDA, even though it's adjusted, but there's a net loss in there as well, which obviously you'd like to see improve over time. You can adjust it if you fancy. You just keep adjusting it until it's profitable, and we'll see how we go. But I think they're doing a pretty interesting job. They call themselves a tech leader in this sector. I'm not entirely sure how. Maybe you'll be able to give me some color on that one, Steve, going forward. But they have stressed they've got an ability, or they've got confidence in their ability to organically grow Beacon, which is this big acquisition's EBITDA, to more than $2 billion. That's a key de-risking factor for this company. If they can do that, they can optimize it, they can integrate it. That would be really, really good. Obviously, you've got this 10-year plan to get to 50 billion in annual revenue. Some of that is driven by organic growth, but you're going to imagine this is going to be a pretty huge acquisition pipeline from them. Maybe they'll acquire Technoglass and save me. But yes, they look pretty good. Balance sheet looks pretty good, Steve. Healthy liquidity. It looks like 2.3 billion in cash and cash equivalents, and loads of dry powder to go out and start buying up stuff. It'd be interesting to follow this one moving forward. I think is it a bit of a pure play bet on this Brad Jacobs M&A and optimization track record? The thing I would point out is that he's 69 at the moment. He's probably going to want to keep going, but do you want to bet he's going to be as good in his mid to late 70s? That to me is a little bit troubling. One of the things that I would say is maybe a sort of amber flag. But yeah, interesting one, Steve. So how did you stumble across this one, and is this something you're looking to buy?
There's a healthy key man risk there, isn't there? The bit about it being kind of tech-led struck me as either, depends on how closely you look, either worrisome or unbelievable to my ears. But now that you've said the things you've said about the North American market, maybe less so. So if you're a roll-up, generally speaking, you want some way of extracting synergies out of the things that you're rolling up. You don't just want to buy all this stuff for the sake of it. And different kind of acquirers operate in different ways. Their idea is to try and streamline ordering and distribution and using machine learning to kind of help manage all of that process and make it more efficient. So they're going to buy all these things and plug them into their central e-commerce platform for ordering from, and help to try and drive efficiencies that way. I'm always wary about machine learning these things. I've seen quite a lot of things go wrong in this case. Stuff like Zillow, which attempted to machine learn how to buy houses, and in fact, it machine learned how to lose a load of money by buying houses. There's that genuine kind of risk there. I remain interested in this, mind you, despite, as I think you're absolutely right in pointing out, he's 69. People do sometimes get kind of either fed up or bored or unable to carry on within 10 years of being 69. So we will see what happens on that. And he's a big part of the kind of story to this, but we'll see what happens. I heard it mooted on a different podcast as a short-term trading idea, and I actually thought I kind of like this much more as a long-term holding thing rather than trying to read the US macro at the moment, which, well, government's been shut down until like today as we record this. So there hasn't been any macro data for me to know what's going on with. But and now that the government's reopened, people have realised that there's going to be data, and actually that data might not be very good, they've suddenly realised. So maybe they liked it better when the government wasn't around. But I am interested in this. I will see how we get on this one. Feels like a gradual work your way into it. It's unusual that I go and buy something that's kind of unprofitable and hope for profits in the future, but I can see a reasonably clear route towards this, so maybe I'm starting to grow as an investor. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.